Imagine you are steadily putting portions of your paycheck into a rainy day jar on your kitchen counter, but the rules say you cannot officially count any of it as savings until New Year's Day. Large commercial banks face a very similar situation. They maintain their own version of an emergency jar, and regulators require them to keep that jar filled to a specific height at all times. This foundational safety cushion is called Common Equity Tier 1 capital, or CET1. Think of it as the bank's core cash reserve, held back to absorb financial shocks and protect the money depositors have trusted them with. To make sure this cushion is thick enough, regulators monitor a health score called the CARR, the Capital to Risk-Weighted Assets ratio. It directly compares the cash sitting in the safety jar against the total risk of the loans the bank has handed out. In May 2026, the Reserve Bank of India updated how this health score is tracked by issuing the Fifth Amendment directions. The update gives banks a practical advantage. They no longer have to wait until the end of the year to count their earnings. They can now add their profits to their safety cushion at the end of every quarter, provided they prove their math. That proof is non-negotiable. A bank cannot estimate or guess its mid-year profits to make its health score look better. The very first condition of the new RBI rule is that quarterly financial statements must be thoroughly audited or pass a formal limited review by professionals before a single rupee goes into the official safety jar. But an audit is only the first hurdle. Banks regularly pay out a share of their earnings to stockholders, known as a dividend. Since this cash eventually leaves the bank, the RBI requires it to be subtracted from the profit total right away. This mandatory formula calculates how much profit is added to the safety cushion. NPT is net profit accumulated up to the current quarter. Subtract expected payouts, the average dividend, D, sliced quarterly by 0.25 times current quarter, T, to get EPT, eligible profit. The RBI offers banks helpful flexibility when they are making money. However, if a bank starts struggling, the regulator takes a fiercely protective stance. The RBI enforces these safety standards using the powers granted under Section 35A of the Banking Regulation Act of 1949, giving them the legal authority to step in and dictate how banks handle their cash reserves. So, what happens if a bank has a bad quarter and actually loses money instead of generating a profit? In that scenario, the careful dividend subtraction formula we just looked at is thrown out completely. A much harsher rule takes over. Under this rule, known as a clawback, any net loss the bank suffers must be fully and immediately deducted directly from their CET1 safety jar. The regulation is explicit. It states, the cumulative net loss up to the quarter end shall be fully deducted, while calculating CET1 capital for the relevant quarter. There's no smoothing out losses over time. Notice the asymmetry here. Profits have to be heavily audited and trimmed down before they can improve a bank's health score, but losses hurt that score today, instantly. This imbalance is entirely intentional. Regulators guarantee a bank never appears financially healthier than it is, especially when economic conditions get tough. The RBI isn't optimizing for maximum bank growth. Their primary objective is making absolutely sure the rainy day jar is deep enough to protect public deposits if a storm hits. While these capital formulas happen quietly in spreadsheets, they dictate how actual money moves through a city. Every coffee shop looking to expand, every family buying a home, and every commercial supplier relies on local banks having the available room in their budget to safely hand out loans. By allowing healthy banks to count their eligible profits quarter by quarter, the RBI clears a major bottleneck. Banks can safely lend more money to the public mid-year, rather than waiting 12 months to unlock their capital. And because of the mandatory audits and dividend subtractions, everyone knows the math supporting those new loans is solid. At the same time, the instant loss deduction acts as a sensitive tripwire. If a bank starts to bleed money, regulators get a real-time warning the moment the safety cushion begins to thin. The 2026 amendment updates the system to reflect reality as it happens. It gives a thriving economy more financial fuel to grow while keeping the safety net firmly in place.